Welcome back, everybody. It's John Klotz, host of Money Talks Media. Today, we're talking RSP Talk with our good friend Mike Evans, Senior Vice President, Mackenzie Financial. We've been having some really good discussions about people getting back off the GICs and those lousy returns more into fixed income like corporate bonds, balanced funds. Now, Mike, we've had those people sitting on the sideline. They say, Mike, I'm ready to get back into equities. Where do you see things going as far as equities, Canadian equities, things like that?
I can tell you what people want. The statistics pretty clearly bear out that Canadians have a bit of proximity bias. They love to play with the home team. They love Canada, and it's easy to see why. The Canadian market has outperformed international markets.
Sure.
Our economy has received accolades for the banking system, the stability during the downturn. We enjoy a wonderful, bountiful riches in way of resources, rocks, logs, all the things that the world needs to grow. So we've got a lot of things going for us right here at home. But I would say that if you're looking for opportunity, oftentimes you need to go where the returns aren't, not where they have been.
Right.
So I'll make this comment. The Canadian market is within 15% of its all-time highs. Many international markets, US, Europe, even areas in the emerging world that have been getting a lot of press, are still well down from their 2007, 2008 highs. So we may have seen much of the equity recovery here already. Not to say that there isn't more, but we could statistically see a bigger bounce from markets that are still well down from their previous highs.
I think that is so true. The contrarian in me, suggests that as everyone's bashing the U.S., if you go to any parties or anything and you speak to people, they'll say it's a terrible country. I believe that's where the opportunities.
Well, one of our best and wisest managers, who, by the way, unfortunately passed away last week, Peter Cundall, was very fond and known for going where others fear to go. Right? He went where disasters were occurring. He went where the best opportunities were. And if you're looking to get great value, as Peter and his team members always did and always have and always will, you want to go where others aren't. And that can be the U.S. I can tell you this, last year, fund flows coming into Canada, roughly 94% were going into Canada. Less than 6% were going into any sort of foreign investment.
In fact, I had many pointed conversations with clients where they said, don't put me in the U.S.
Yeah.
And so where are those? Let's talk about those opportunities. Where do you...
Well, as we mentioned, Canada's seen some great rebound. The U.S. hasn't. I've been reading a Goldman Sachs U.S. equity outlook piece that kind of looks critically at all elements of the U.S. market and is kind of asking itself, where should people go? First line of the report says a superb backdrop for U.S. stocks to rise 23% in 2011.
U.S. stocks 23%.
U.S.
Is he talking about
that's Goldman
large
Sachs.
cap? Is he talking about
that's the market? That's the market overall.
Okay.
And they highlight cyclicals. They like information technology. Many people haven't talked about IT, technology, sort of the growthier end of the market for the better part of a decade.
Well, it was 2000 that the tech meltdown occurred, and
and we're still not halfway back, right?
That's right.
The NASDAQ, I think, is somewhere in the 2,500 range.
Right.
It peaked out at 53, so we're still well down from the previous highs.
Interesting to hear that. Carry on.
Financials. The U.S. financial system was severely beaten down. We have a number of managers focusing on recovery in the financial sector.
Which companies are they looking at?
It wouldn't necessarily have to be some of the aggressive plays like Citigroup or Bank of America, but a manager, Ian Ainsworth, who runs a North American growth fund, has been highlighting Wells Fargo and JP Morgan as two excellent positions in the U.S. But there's so many wonderful brand name companies in the U.S. market that are in some way or another out of favor, highlighting some of the positions in both our Cundall and Ivy foreign equity funds. Companies like Dell, FedEx, McDonald's, Nestle, Costco. These are household names, brand names for everyone, and you're getting them at well down from their previous highs. One of the greatest economies in the world that I don't think can be discounted, and certainly not written off.
Absolutely. Clearly, as one who was at Costco on the weekend, they are doing something correct.
Yes.
And as witnessed by on being unable to spend less than $500 at a visit and waiting 20 minutes in that lineup. So
yeah,
there you go.
I went in for razor blades and a piece of meat and walked out with a $225 bill the other day.
See,
Very
there
happy.
you go. It's
Wonderful.
working. It's working.
Wonderful food.
They're clearly doing something right. So carry on. So okay. And
So international themes. Canadians have a lot of Canada. And so the question I would ask both you, your listeners, any advisors out there, how much foreign content is the right amount? So I think we know that 0% is not enough.
right.
100% is probably too much. The real appropriate allotment for foreign content is somewhere in the middle. So ask yourself, do you have enough? And are we looking in some of those unloved, underappreciated, underperforming areas to look for tomorrow's best performer?
So we've established that there is some opportunity in the U.S. And if one was to look at a fund that really could take advantage of that within your mandate, which fund would you recommend?
Well, our two leaders on the international side are the Ivy Foreign Equity Fund and the Cundall Value Fund.
Right.
Now, coincidentally, both top performers over a 10-year basis, upper left-hand corner, clear standouts, and the two actually combined together perfectly well, such that this year, or 2010, we created a one-fund combination of those two funds called the Founders Global Equity Fund. So you can now buy two of the industry's leading foreign funds in one purchase.
Well,
Right? So that would be part of my international story. The other component that has been much talked about and that many investors are looking at is the emerging world. The
let's
emerging
talk
markets.
about that. Very exciting.
Well, it is. And funny enough, when people talk emerging markets, the same descriptives come up: aggressive, volatile, expensive, low yielding, the sort of acronyms for very aggressive come out. We recently had a meeting with James Morton, one of our top international managers who focuses on two funds, our Cundall Emerging and the Cundall Recovery funds, as you know well. You're a big supporter of both. And he brought to our attention some of the misconceptions about volatility and risk associated with the emerging world. If you look at our Cundall Emerging and Cundall Recovery funds, I'll use Cundall Recovery,
please,
one of our largest, focusing primarily on the emerging world, big positions in Russia, Hong Kong, Indonesia, China, for example, and looking at some of the fastest growing economies in the world. It currently trades with a 2% dividend yield. That's higher than the S&P 500.
Yep.
Trades at an 8 PE multiple.
Right.
Any guesses what the Canadian PE multiple is on average?
That's I'm going to let you answer that because
20.
20, right.
The US is 14-ish, so it's a fraction the PE of many of the developed areas, including Canada. It trades at somewhere between a 25 and 40% discount to its conservative net asset value calculation. So every position in the portfolio is assessed for its true value, and the Cundall team, James and his partners, are really only excited if they can buy that great company for pennies on the dollar, right? So if it's valued at $1, if they're paying 50 cents, they're really happy. Well, on average, the portfolio is trading somewhere between 25 and 40% below their conservative NAV valuations. This fund has been around for 12 years. It's had one negative year in 12 years, and a since inception compounded rate of return of 12%. It is one of the best performing funds of any sort, not just on the foreign.
This is the recovery fund.
Recovery.
I mean, obviously more volatile than some of your other products, but
well, one negative in 12 years doesn't add up to much in the way of negative volatility. Now, 2008 was an exceptional year for volatility, and not that the selections made by the management team were in any way called into question, but many of these markets just decided to close down.
Absolutely.
But it's certainly rebounding. It's not back yet to its old highs from 07, 08. So from an investment perspective, still a great place to invest. I'll sum it up like this.
Go ahead.
The emerging world the developed world is going to struggle to grow at 2%, given debt levels and problems with bailouts and the imminent tax increases and the issues in the developed world are very large. The growth level in emerging markets is going to be double digit, right? Some of the fastest growing economies in the world. And that's really what we're looking to tap into with that funds and others like it.
Interesting. And what do you recommend, just as some of our closing comments, percentage portfolio that people have in like emerging markets?
Well, that's really up to the individual investment advisor and the tolerance of the person investing.
Right.
But when we had James here in the fall, he runs two funds, Cundall Emerging and Cundall Recovery. And people asked him really two questions. They said, James, which one of your two funds, Cundall Emerging or Cundall Recovery? And he said, of the two, I think the better opportunity is in the Cundall Emerging Fund. It's a smaller fund, only $250 million rather than the $1.5 billion in recovery, and is very dedicated to those emerging areas.
Excellent.
Second question, how much? What percentage? He again qualified it and said, I can't speak for everyone, but I can tell you of my investable assets, 50% is in this area.
Isn't that interesting?
So
okay.
50% may not be for everyone,
right,
but it's an area underrepresented by
absolutely
many.
0 to 50. Okay, we'll find some more
Represented by
absolutely
many.
0 to 50. Okay, we'll find some more conservative number in there. Anyway, Mike, it's been great having you out. We appreciate you coming and sharing some knowledge with us. This is Money Talks Media. Going off the air, we appreciate the opportunity for you to hear some of your thoughts.
John, thanks for having me on.
My pleasure. And we will see you in 2 weeks' time when we have the Excel funds coming out to talk about just emerging markets. Money Talk Media is going off the air. Have a great day. Take it away, Blue.